Good afternoon, ladies and gentlemen. Thanks, David. What I want to talk about this afternoon is why this is the hottest M&A market ever, and what I think you should be doing about it in your portfolios. Ten years ago, I wrote a book called Early Exits. I described some of the trends that I was seeing in the early stage company exit market. It was clear then that big companies were outsourcing innovation to entrepreneurs. There was an increasing startup capital efficiency, which has continued dramatically. There's the ascension of angel investors, and there's a lot more pre-profit and pre-revenue exits. And in total, there was a trend to earlier and faster exits than we've ever seen before. That's unfortunate.
Thank you.
Thanks, David.
No problem.
But 10 years ago, I could not have imagined what we're experiencing now. All of the predictions in the book happened, but Got it. My fault. Sorry, operator error. Got it. But nobody expected this explosion in liquidity or the resulting and very dramatic increases in valuation. There's no doubt this is the hottest M&A market in history. This graph shows what's happened since 1998 in the United States, Europe, Asia Pacific, and Japan. The important thing to note in that graph is the top line. You can see the peak in 1999, which was a great M&A market. You can see the peak in 2008, and you can see the peak now at about $2.5 trillion just in the first half of this year. And this is happening in every part of the developed world. But you know, trillions of dollars are hard for most of us to relate to. So what I'd like to do is to illustrate what we're seeing out there by describing the transactions that my boutique investment bank have completed in the first half of 2018. And what we do is we sell angel-backed and early-stage bootstrap companies. And unfortunately, like 95% of all of the transactions in M&A, the information that we have is locked down by some pretty tight NDAs. So what I'm going to do to work around that NDAs is I'm going to talk about the three transactions in aggregate because I think they nicely illustrate what's happening in the market. So in the first half of this year, we sold 3 companies. All 3 of them were 2 to 3 years old, just like I described in Early Exits 10 years ago. 2 of the 3 founders were under 30 years old when we started. 2 of the companies were virtual companies. No headquarters building, people scattered all over the world. One of those companies that we sold only had 1 employee. And only one of those companies actually had investors, and those were angels. The other 2 didn't even need capital because they were so capital efficient. Only one of those companies was profitable. 10 years ago, people still hadn't really understood that profitability wasn't a factor. But one of those companies had no revenue at all. And the one with no revenue was the most valuable of the 3. And the total value of those 3 transactions was over $300 million. I wish I could talk for half an hour just about how those transactions illustrate what's happening in the market. But I think the important point is that I don't think any of those 3 transactions would have happened just 5 years ago. And they certainly wouldn't have happened anywhere near the valuations that we achieved. And in addition to the trends in early exits, the biggest change has been this explosion in liquidity. And that doesn't just affect angels and entrepreneurs. It literally affects every debt and equity investment everywhere in the world. And so what I'm going to try and do, and this is my first attempt at trying to do this, I'm going to try and summarize that in like 10 minutes. So the first thing that I think is the driver to all of this is what the central banks are doing around the world. This shows the Fed, the European Central Bank, Japan, the Chinese Central Bank. If you look at what the trend is, all of those central banks from 2000 have been dramatically increasing their balance sheets. You typically read about it being described as quantitative easing, or QE. What it really is they're printing money. That's really the net effect of what you're seeing there. And that green box shows what happened at the beginning of the mortgage crisis in 2008. That green box shows the amount that poor President Obama had to authorize to bail out the global economy in 2008. That was an absolutely terrifying amount of money, I thought at the time, which was about 0.7 trillion. So if you look at that graph, you can almost not see that terrifying 0.7 trillion because it's not really very big in that graph. And look what's happened since. And what's also interesting about that graph is, did you notice that all of the central banks were doing the same thing at the same time? And what's happened, I think primarily because of the internet, but also low-cost travel, is the world has become a much smaller place. And the global economies are much more synchronized than ever before. This is an entirely new phenomena in the history of mankind, and we haven't really figured it out yet. This graph shows just how incredibly correlated the world's equity markets have become since 1975. You can see in 75 to 1999, there wasn't a lot of correlation, running around 0.4, not a really tight number, but now it's almost a perfect correlation. The whole world is expanding at the same time for the first time ever. So this quantitative easing, this printing money, caused an explosion in the money supply. This graph is just for the US, because it's easier for us to wrap our heads around. And again, you notice that green box pointing to that enormously terrifying 0.7 trillion in 2008. And it's almost a blip in that total picture there. There's been an explosion of money everywhere in the world. I'm seeing some horrified faces in the audience. I hadn't intended to scare anybody this early. So one of the places that this liquidity has gone is onto corporate balance sheets. And you can see that around 1999 or 2000, maybe companies on average, this is S&P companies, had maybe 15% of their balance sheets in cash. Now it's double that. So companies today have twice as much cash as they had 10 years ago. They have so much cash that it's actually a pretty serious problem because the stockholders keep wanting them to dividend it out, which they're doing. And they're also buying back their shares in the markets as fast as they can. But they still have more cash than they've ever had before. And it doesn't really show any sign of declining because there's so much cash out there. But it's not just gone onto corporate balance sheets. It's also gone into private equity funds. And you can see here in this graph that the amount of dry powder, which is what the PE guys call the money they haven't invested yet, has gone up from around 2003, maybe it was 0.4 trillion. Now it's 1.7 trillion dollars. That's just in the PE industry. And those guys typically will take that money and leverage it 5-6 times to 1. So that might be $10 trillion worth of money desperate to buy companies. And it's definitely driving up valuations. When you talk about the supply of money, that's kind of a difficult concept to wrap your head around, at least for me. And even the economists don't really agree on how you should measure the supply of money. But it's much easier to see the effect of that supply of money, which is the cost of money. And that, of course, is the interest rate. And so if you look at what's happened to interest rates since 2008, since the last downturn, you can see again how the central banks in England, Japan, China, Europe, all around the world have all at the same time done about the same thing. Again, a very dramatic reduction in the interest rates on the short end set by the central banks, but the degree of correlation reinforces that graph that shows the whole world is operating synchronously. At least the developed part of the world is operating pretty synchronously. What that's done, that extreme amount of money and that pressure on the short end by the central banks has driven down interest rates to the lowest levels in 5,000 years. So this graph starts at about 3000 BC, and it shows the long rates and the short rates. And we all know, because we're all feeling it, anybody who has money who tries to get a return on it can feel it, the interest rates have never, ever been this low. Again, the effect, increased valuations. Valuations have gotten so low that there's lots of places where the interest rates have gotten so low that they're actually negative. And this is another one of those really hard things to understand, because initially the idea of a negative interest rate doesn't seem to make any sense. And the longer I think about it, the less I'm able to make any sense out of it. But what this is showing is it's about $7 trillion worth of government bonds that have negative interest rates. So you invest $100,000, next year you're going to have $99,000. To me, that suggests something's terribly wrong somewhere in the system. It's so bad now that there are companies, at least one that I know of in France, companies that are issuing bonds with negative interest rates. So you give your money to a company, and they promise to give 95% or 99% of it back. And people buy those bonds all the time. It's a lot easier to think about equity valuations, because most of us are talking at this conference about investing in equities. The ones that we invest in are private transactions, so we don't have convenient graphs that describe how the prices have changed. And in the M&A market, even though some of those transactions are by public companies and are disclosed, we really don't have a way to gather the data so we know what the valuations are. So what I'm going to be using is kind of public market equity valuations as a proxy for what's happening in the M&A market. Here you can see what's happened to the NASDAQ since 1999. We had this big bubble on the far left-hand side. We all remember that. But look what's happened to the NASDAQ in the last few years. It's gone far higher than it was before the crash in 1999. This is the NASDAQ presented, I think, in a more useful way, because it's normalized against the size of the economy. So if you look at this graph, which shows the ratio of the NASDAQ market cap to the GDP, again, you see in 1999, there was this big peak, and now valuations are just about back to where they were in 1999, 20 years ago, right before the tech bubble burst. There's tons of ways to look at valuations, and I'm just going to quickly throw out a couple here. One of the long-standing principles in valuation is that you shouldn't be paying for public stocks a price-to-earnings ratio that's much different than the growth rate of the companies. Well, today we're paying about twice what we all read in the textbooks we should be paying for companies. Here's another way, another simple metric, the price-to-sales ratio. This is a harder ratio to tweak with accounting methods and the kind of things that you're reading about in the press. Price to sales is a more fundamental measure. It's also about the same level as it was in 1999, just before the crash, and about twice what we've paid on average for companies. And again, this is the S&P. These are not entirely tech companies. Tech is big in the S&P today, but this is a cross-section of companies in America that are public. And Warren Buffett, who I think we'd all agree is a pretty successful investor, he has said that his favorite way to measure valuations is to measure the market cap of the index against the GDP. And he's a kind of a mid-market guy. He likes the Wilshire. Here you can see that the ratio of the Wilshire 5000 to the GDP is just a little bit higher than it was in 1999 and higher than it's been at any time since 1970. So if Buffett's right, the market's pretty highly valued, which is another way of saying valuations are really high. Another interesting indicator for us as early stage investors is that if you look at the IPO market, and this graph goes back again 20, 30, 40 years, in today's market, 80% of the IPOs have negative earnings. In other words, they're running a loss. And that was just like it was back at the previous peak on that graph in 1999. Are you noticing how often that similarity to 1999 is coming up in these valuation metrics? Today, literally today, by some measures, we are marking the longest expansion in history. People sometimes debate how to measure it, but the predominant thinking in the American investment community is today is the day that we mark as the longest expansion ever. And so I guess the question is, should that worry us? The thing about low interest rates is that they're really great for valuations. And we've all been feeling that. At least those of us who have been selling things have been feeling that. But low interest rates also encourage people, companies, and governments to increase debt levels, to borrow more. This graph also starts in 1999, and it shows the amount of debt in the entire world. And you can see in 1999 there might have been, $80 trillion worth of debt. Well, today there's $240 trillion of debt in the world. So the debt over the last 20 years has gone up by about 3 times. Again, I don't know anybody who can relate to $240 trillion. That's an unimaginable amount of money. So let's just talk about America. This graph shows the debt in this country compared to the GDP. So it kind of, factors out the size of the economy. It considers what amount of debt we can afford. And the current debt level was only higher once before, and that was after the Second World War. And that was because, we had to borrow a lot of money for armaments. There was posters on every street corner suggesting people should buy war bonds. And a great deal of debt was accumulated to win the Second World War. And it took a long time to pay that debt down. But that was during the biggest economic boom in America's history through the post-war years. Today, we're at the second highest level of debt ever here in America. But what's worrisome is that the projections today from the Congressional Budget Office, not some radical media guys, the CBO says that blue curve is the trajectory of debt here in America. Today, for the first time ever, we're going to be seeing about $1 trillion deficit in America. So I was terrified 10 years ago when Obama wrote a check for $0.7 trillion to bail out the world's economy. Today, every year, we can't come up with about $1 trillion, which shows you what's going to happen over the next while. The thing that is a concern, I think, to every investor is that there isn't any math or any economic model that shows any way to pay that debt back. And, you might think, well, those damn economists, they're always saying these kinds of things to scare us. Just a few months ago, Pierre Trudeau, Prime Minister of Canada, said when he was talking about the U.S. debt that it was not sustainable. I know, Canada, small little country, should have been a state a couple hundred years ago. Not to worry about him. But what much more worrisome to me was Jerome Powell, pretty important guy in the global economy, perhaps the most important guy in the global economy. The current Fed chairman said, the U.S. is not on a sustainable fiscal path. I don't think a Fed chairman has ever said that before, not while they were sitting. But if you read what Janet Yellen, Ben Bernanke, Alan Greenspan have all said recently, they all agree. That amount of debt here in America is not sustainable. Most of us don't think too much about what that means. It's hard to think about what that means. But that's what the current Fed, the previous Feds, crazy Canadian Prime Minister, but more importantly, almost every respected economist in the world is saying the same thing. So if you look at what history can show us about this type of situation, there's really only 2 outcomes from here. The only ways that debt can be reconciled is either by inflation or default. And inflation is still very low. This graph, that I'm sure most of you are familiar with, shows inflation over the last decade or so. Inflation has been stubbornly low. despite the best efforts of the central banks, and one of the reasons they've put so much money into the system is they've been trying to get the inflation rate up to what they would consider an acceptable level. And they haven't been able to, except, possibly now if you kind of squint at the end of that data set, you can start to see a little bit of inflation. But what's also happening right now is that the Fed here has hiked interest rates 6 times. And this is a difficult graph to wrap your head around because it goes back to 1950, but it shows every time that the Fed's increased rates before. And every one of those red circles is what happened when the Fed increased rates before. And the Fed has kind of a perfect record in what happens when they start to tighten, is they tighten until, as they say in the economic industry, something breaks. So we're 6 hikes in. This is what the history has shown us has happened before. And what we haven't ever seen before, though, is that this enormous amount of quantitative easing, this is showing, by the way, the year-on-year change in quantitative easing. So the first graph I showed was the cumulative amount. This is showing the rate of change. For the first time ever, the Fed is now reducing the quantitative easing, or they're doing what they call quantitative tightening. And the other central banks, notably Europe, has said they're going to do the same thing. Japan kind of talking about it. China, hard to understand exactly what those guys are doing. But this has never happened before, ever. We've never had synchronized quantitative tightening before. And nobody knows what's going to happen. Janet Yellen, previous Fed chair, said just recently that the Federal Open Market Committee, the guys who make the decisions at the Fed, doesn't have any experience with doing this. She said publicly, we don't have any previous experience, in other words, we've never done this before, and she said, we don't really know what's going to happen. And everybody agrees. The current Fed chair, all of the big bank CEOs, they're all saying the same thing. We've never done this before. It's a unique time in human history where we've had this enormous amount of quantitative easing starting to reverse. And it also is not possible to know when this might in fact affect the investment environment. There are enormous elements of psychology in the timing of whatever's going to happen. So in summary, what I've tried to show here is that the central banks around the world have been providing an unprecedented amount of monetary stimulus. They've reduced interest rates to the lowest levels in 5,000 years. They've also printed more money than we've ever seen before in history. And this money has flown into every part of the global economy. And it's increased equity valuations to where we were, or maybe even a little bit further than 1999, which was the previous peak, no matter how you measure it in valuation. So these record high valuations and other fundamentals have made this the hottest M&A market in history. It's the best time ever to sell companies. My team is beside themselves with how much fun they're having helping these young entrepreneurs that have 2 or 3-year-old companies sell them. And other angels that I talk to, almost every other kind of investor, is just giddy with excitement about how much money you can get for equities today. I've talked for years about how I think that we're in a golden era for entrepreneurs and angels. And I've got a talk that I gave at the business school up in Vancouver on why that I believe this is the best time that we've ever seen for angels and entrepreneurs. So that's kind of the glass half full part of where we are today. The best time ever by far. But while it's pretty easy to be sure this is the best time ever to sell, if you aren't thinking of selling something now, I think you have to be very cautious. Be very careful about the valuations that you're paying to enter investments today. And remember that the Fed always tightens until something breaks. And they've been tightening now for a while. So The big concern, I think, isn't the tightening on the interest rates as much as the fact that there's never been this much debt in the world before, ever. So what I think in summary is that thinking about all these things, I think it's just prudent to plan your businesses and think about your portfolios, keeping in mind the big picture, because the markets are bigger than any of us. I think I've got a couple of minutes for questions, if I'm correct.
Please round of applause for Basil. Thank you so much. We are going to go ahead and bring up our exit panel here as well in the next few minutes, but let's go ahead and get it open for some questions here, and then we'll roll into some questions for our panel and bring up some other color commentary to talk about it. So let's see here. Go ahead right there. You just talk loud.
Yeah, I read a book by a couple brothers, last name Bolio, and I'm forgetting now the name of the book, that essentially circles 2030 and says that's when the crash will come, when the debt's due, and we have to plan accordingly. Is that more or less where you're thinking this all comes to be?
You know, you're asking me a question about when this could happen. I'd love to do an hour-long presentation on that. If history is any guide, it's probably a lot sooner. Because again, the Fed, in this case, has been very clear. They're tightening once a quarter, about a quarter point. And if that's true, and if every previous episode ends like this one's going to, I would say it's more like 1 or 2 years from now.
So back when Obama wrote the $700 billion check, if you were never to take care of the world and stepped in, what would you have done differently? Because all the countries just followed what he did, it looked like.
Yes, no, there was, at that point, there was no choice. You know, the money was gone. The money that had been invested evaporated. If they hadn't borrowed it from the American future and put it into the markets, I think there's probably a good chance that the world would have imploded at that point. It would have looked like the previous times things like that have happened, 1929 kind of event.
Other quick question? Go ahead, Colin.
There's a lot of forecasting that I'm reading in the financial markets, both quietly and loudly, that we are looking at a fairly aggressive retracement within 20 months.
Yes, that's the kind of thing I'm reading too, and I think that history shows that's a pretty safe bet. Something, 50% kind of range is what I'm typically reading that the smart economists and investors are predicting.
Is it some time, maybe the first time in history, we should give some alternative considerations to fiat currency? And I'm not blessing it that we quite do this crypto, but there are mechanisms of tokenization or even Chinese a non-dollar or whatever standard. It seems like we're in uncharted territory. It seems like we need to be thinking about some things to combat just looking at the inevitable outcomes that a lot of people are prognosticating. Is there maybe, if we're creative, could there be some untried alternatives that could be an alternative to the currency?
What a wonderful question. I'd love to spend a whole day talking about that, but very quickly, on Monday we saw the first national cryptocurrency. The question was, are we looking at a time where this amount of debt is going to create such a big problem that we aren't going to be thinking about using, say, US dollars for international trade anymore? There's a lot of talk about this right now. Our cryptocurrency is part of the solution. On Monday, Venezuela created the first national cryptocurrency. That one was backed by petroleum. China and Russia have been talking publicly for some time about an alternative to the US dollar payment system. And to my absolute shock, this morning, Germany joined China and Russia in saying that we had to have a different system than the one that we've had since Bretton Woods at the end of the Second World War, because the US dollar was no longer going to be a viable method of international trade. Who knows what that's going to mean? It's certainly going to mean for some very exciting reading in the financial press, but I think it also means that we have to think about this. We can't ignore problems like this in the macroeconomic system when we're investing money and thinking about strategies for our companies. Thank you very much. I'll be on the panel. You can ask some more questions if
Thank you, Basil.